Hello friends, welcome to my another edition of my webinar series Financial Bites at Dhantripti. I am Arun Mathur, certified financial planner and founder of Dhantripti Financial Planners. Today we are going to talk about life insurance. Before I start my presentation, a small disclaimer. The advice which I give here is general in nature and may or may not suit an individual. Please consult your own advisor before you follow. The topics which we are going to cover today are as follows. First, we are going to talk about what life insurance is all about and what are the inherent characteristics of insurance as an asset class. We shall then try understand few terms related to insurance plans and the types of insurance plans which are available in the market. We must also learn to choose an appropriate insurance policy for us and how we should go about calculating the right sum insured for us. And finally, we will look at certain best practices which we should keep in mind when we buy insurance policies. So moving on, let's first understand what life insurance is all about. So it is just a way to protect oneself from financial loss. In case of life insurance, a death of a bread earner would be a financial loss for the family. So life insurance is primarily taken as a protection for the family. It should be our priority number one. In India, today there are 24 insurance companies which provide life insurance policies. Now, there are two types of insurances. One is called life insurance and other is called general insurance. Life insurance can be again three types. It can be a term plan, it can be an endowment plan, or it can be unit linked insurance plans. While general insurance is what is concerned with health, property, or any other insurances come like liability insurance, fire insurance, marine insurance, all of them come under the category of general insurance. And we will talk or focus more on life insurance in this presentation. What are the inherent characteristics of an insurance as an asset class? The first thing is whenever you take an insurance policy, basically it is a contract between two parties, insurer and insured. So one who takes policy is the insured person and the life insurance company is the insurance. So it's a contract. Secondly, it is done basically to do a transfer of risk. So if I'm taking an insurance, I have a risk of financial loss or my family bears this risk if I'm not there. So this risk is transferred to the insurance company. So this is known as transfer of risk. So the financial loss will now be incurred in case of a demise of a insurer, of an insured. The risk is taken by, the loss is taken by the insurance company. Now the loss which can be insured has to be unexpected or an accidental loss. So any deliberate losses or losses due to gambling, etc. cannot be insured. Finally, it works on the principle of pooling of losses. What it means is that if 100 people together take a policy and one of them incur a financial loss, the all other people who are the member of that insurance policy contribute towards making good the loss incurred by a single person through their premium. So it's about pooling of losses. It also works on indemnification. Indemnification basically means that after the event has happened or a financial loss has happened to an individual, he will be restored back to a financial position which was there before the insurance was taken. So it is insurance is not for profit making, it is basically for making good the loss which has happened due to certain event. And finally, it's a risk management tool. Now, risk in our life cannot be avoided. We have to live with the risk, we have to manage the risk. So, insurance is a very good tool to manage your risk. Now, moving on, we must understand certain terms which are related to the insurance policies of the plans before we buy them. So some terms are, for example, sum assured. Now, this is the amount of money which you or which your family is going to get, or a family of an insured person is going to get when that insured person dies. So it is a very customized calculation of arriving at what is the right sum assured for an individual, and we will see this in after few slides. The second important point to understand is what is a policy period. So policy period is the period of the contract for which insurance company is going to cover you. So people can take a policy period from as low as 5 years to whole life. Whole life means till the age of 100. The third important term to understand is premium. So premium is the amount of money which a insured person pays to the insurance company. Now, this can be paid either on the annual basis or quarterly basis or even sometimes on monthly basis. Next term is premium payment period. So this is the period, or this is the number of years the insured person is going to pay premium for. So you have regular pay plans and a limited pay plan. So if you are paying for 5 years, 10 years, or sometimes even up to the age of 60, these are limited payment plans. And if you continue to pay for an entire policy period, then it's called regular pay. We must also understand what is death benefit and maturity benefit. So amount which an insurance company pays to the family of an individual when he dies is the death benefit. But if the insurance insured person survives the policy period, then he again gets some benefits which are known as maturity benefits. So some of the policies come with only death benefits, while some come with both death and maturity benefits. And we will see this more in detail in our later slides. And finally, the term riders. A lot of insurance plans come as term riders. So term riders are what? They are certain additional benefits to the basic insurance policy which come at low cost. But these additional benefits are for limited time. And some of the examples are ADDL, which is accidental death and disability liability, or critical illness. We'll talk more about this in later slides. So having understood the various terms which are related to the plans, let us try and understand what are the various types of life insurance policies which are available in the market. So primarily the life insurance policies can be divided into two parts: term plans and endowment plans. Term plans, the characteristics of the term plans and endowment plans are quite different, and it's very important to understand this. For example, term plans are pure risk cover plans. They do not have any investment element. So whatever premium you are paying are basically to cover your risk, and no part of the premium is put as an investment. On the other hand, the endowment plan are basically a mix of an investment plan and risk cover. So here, whatever you are paying as a premium, the majority of that premium goes as an investment. It is invested in certain debt instruments, which are risk-free instruments. Not risk-free, but they have little risk associated with them, and therefore your money also grows over time. Okay, so such plans are called endowment plans. Then term plans usually come, you get large sum assured for low premiums. So suppose a person the age of 30, if he goes for a 1 crore sum assured plan, he may end up paying only 10 to 15,000 as premiums. While when you take an endowment plan, you have to pay very large amount of premium, and the sum assured is very low because majority of the premium is going as an investment rather than covering your life, or providing you an insurance cover. Now, term plans only come with death benefits, right? And that means that if you survive the policy, you don't get anything. Only within the contract period, if something happens to you, you get death benefits. While endowment plans come with both death benefits as well as maturity benefits, because whatever money you have been investing also matures at the time of maturity of the plan, and you get that money back. Now, these days, term plans have started coming with a lot of variants and term riders. The variants could be that in some cases, the premium which you have paid in the entire policy period is returned, or some amount of money is paid back to you even if you survive. And term rights, as I said, ADTL riders, critical illness riders are also added on to the basic plan. Now, endowment plans come with a lot of different names: money black plans, whole life plans, child plans. All of them are types of endowment plans. And in term plans, when you take a term plan, the eligibility of taking a term plan is that depends on your earning capacity. So very important to note: a person who does not earn is not going to get a term plan from an insurance company. So homemakers or children or retired people are not eligible for term plans. While in case of endowment plan, your eligibility is determined by the premium paying capacity. So even if you're not earning, if you've got a high premium paying capacity or somebody else is paying premium for you, then you can take an endowment plan. So these are the primary differences between term plans and endowment plans. Which one is better, or what are the pros and cons? We'll look at it in the last slide. Another point to mention here is that ULIP is also type of an endowment plan. The only difference here is that in case of a normal endowment plans, all the investments are made as per IRDA guidelines into debt securities which have very low risk. While in case of ULIP, whatever the investment is done from the premium an insured person is paying goes into market related securities like shares and other bonds, and which have got certain amount of risk associated with it. This is the only difference between endowment plans and ULIP. Now moving on, we must also understand that when we buy an insurance plan, after having understood all the terms of it, what is the right sum assured we should be buying for? So to calculate the sum assured, there are two methods. The method one is called income method, or the economic value of human life, while there is a method two which is known as expense replacement method. So what exactly do we do in this calculation is that in method one, we calculate the net monetary loss the family is going to incur if the bread earner dies. So if a bread earner dies, we will calculate what is the monetary loss to the family, and then, and of course it is over the years he would have earned, and then we calculate the present value of all his future incomes. That gives us the value of how much a person should be insured for. Similarly, in the expense replacement method, instead of income, we look at the expenses which the family would be requiring in case the bread earner is not there. And again, we calculate the present value of all the future expenses, which gives us a value, uh, uh, which which can be used to calculate the sum assured. Right now, in the next slide, we are going to see only one of these two methods, which is the income method. How the detailed calculation, how we arrive at the sum assured value. So let's take an example of Mr. X, and remember this method is called human life value method. We are trying to ascertain the life, what is the life value or the human life value of Mr. X. As a step one, let us say Mr. X has a post-tax income, an annual income of A, and this has to include his rental income and other interest income. These incomes, which in any case are going to come if Mr. X is not there, that we need to exclude. So only that income A, which is directly related to the working of Mr. X. From this, we will subtract B. B is the personal expenses Mr. X is incurring on an annual basis now, because if Mr. X is not there, the expense B is also not there. So the net loss to the family will be A minus B, again, which is an annual value, and we take it as C. Now, at the point when Mr. X is looking for insurance, he may be having N more years where he is going to earn. So he is going to retire after N years, and his growth rate of income per annum is taken as suppose G%. Okay. Now, rate of investment of the insurance proceeds. So what we are trying to see here is in the step 6, that if a person dies and his family gets a lump sum money, they are not going to use the whole money immediately. So they are going to invest that money in certain risk-free instrument, and let's say the person the rate of interest for this amount is for this investment is R%. So having written down all these values A, B, C, N, G, and R, we apply a formula in Excel which is called present value of growing annuity, PVGA. So using this formula, we get this sum assured. Let us again understand this with the help of an example. Suppose Mr. X now is age 35 and he will retire at the age of 60. His present income is 25 lakhs, that is the next net income after tax, and his present annual expenses are 5 lakhs. So the loss to the family on per year basis if Mr. X dies is 20 lakhs. And suppose he has n years of working life left. So 25, 60 minus 35, 25 years of life, working life is still there. His income is supposed to grow at 10%, and the money which his family gets in case he dies, they are going to invest at 7%. So putting all these numbers in a PVGA formula, we get the sum assured requirement as 3.66 crore. So this is one way to calculate your sum assured. So every person who is going for an insurance policy should do this kind of a calculation with the help of an advisor to arrive at the right figure for which the insurance has to be taken. Now, what are the various best practices we must follow when we are buying an insurance plan? Now we are very clear what life insurance is, what is a term plan, right? What are the various terms? How do we calculate sum insured? So now, what we must be doing when we are buying a term insurance plan? So the first thing, important thing is we must always buy a term plan rather than an endowment plan. Remember, what is the objective of the insurance? It is protection. Now, protection, large cover is required at low prices. You get it only in the term plan. While endowment plan is a mix of, as we saw, it's a mix of savings and cover. But remember, the savings which we do are invested at very low earning rates of hardly 5% to 6%, and it has got a long lock-in period. So it is always good to take a term plan first, or rather a term plan to cover your insurance, and and should not be treated like an investment policy. Okay. We must also try and avoid riders if we do not understand, or if those riders are of no use to us, because they only unnecessarily add and make our premiums higher. Second important thing when you're taking a plan is, and of course, suppose you have chosen to take a term plan, is that we select the sum assured correctly by doing our need analysis. Just as we saw in the previous slide. We must focus on the cover rather than on the premium. Most of the people are trying to buy insurance policy looking at the premiums as to what they can afford, what they cannot afford. They have some vague idea about what they can afford as a premium. But instead of doing that, we must focus on what is the right amount of cover I need, because remember, this cover is for not me, it is for my family. The policy term should also be taken only for the earning period or the liability period. What it means is that because I'm going to earn, say, till the age of 60, that is the only period up to which I have the economic value. After that, when I'm not earning, I don't have an economic value, and therefore there's no. So even if I am not there, economically it doesn't hurt the family. Therefore, insurance should only be taken for a period where you are earning, or max up to the period you have liability. Suppose your kids are not going to be completely independent before 60, or they will so you can take it maybe for 65 or 70 years, but not beyond that. Always try to opt for a regular payment, because it's a better option over a limited pay. But one can take a limited payment option also if he wants to just pay for next 8-10 years and quickly get over it. In case you are not able to afford a term plan as per what is needed, you can take it in steps. You can start with a small sum assured, and as your income grows and as you evolve in life, you can add more policies, term plans to your folio so that your sum assured cover increases. And of course, buy early in life, because when you buy it in younger days, your premium is lower and it gets locked over your entire life. And secondly, in later part of your life, health issues may crop in, which may result in loading of the premiums, or you may be denied the policy completely. And of course, finally, spread awareness about term plans. I hope you liked this presentation and understood more about life insurance policies. For any queries or on your feedback or comments, you can write to me at my email arun@dhantripti.com or ping me at my WhatsApp. I'm also available at my social media handles. You can subscribe to my video channels if you really like my presentations. Thank you very much, and see you again soon.